Welcome, ladies and gentlemen, to Silicon Valley Entrepreneurs Forum. Thanks again for being here today. Do you guys remember where were you when you got the news? When Silicon Valley Bank collapsed?
Yes.
Do you have an interesting story, sir? Where were you?
My startup actually banks with SVB, so yeah.
Oh, so you got the full throttle of it. You were in the middle of it. A dear friend of mine actually works at KPMG, and automatically that was one of their top clients, and he got wiped out. So he was stressing, and I was like, oh, okay, this is... Did you guys know this is also, they were just shy of 40-year-old company. They were in Santa Clara since 1983, so there have been an ecosystem for our startup entrepreneurs in Silicon Valley for nearly 40 years, and boom, overnight, gone, done, disappeared. Now, big shocker. I know, George, we're gonna kick things off with you since you worked with them. You were in the trenches with them. When did you get done?
Well, I started at SVB in early January 2014 at the credit risk department. And I was responsible to do due diligence work for a portfolio of startups, technology startups, and the bank's entire winery portfolio. And the bank, well, a lot of people didn't know that this SVB actually have a really big winery lending practice, and they are probably one of the biggest. And that's considered to be their specialty, besides the technology side.
That is a unique proposition for them. And then when did you leave?
I left the bank in 2019, just before the pandemic hit, and I decided to start my winery, venture into my wine passion in wine in 2019, and yeah, that's really
Fantastic. Yeah.
past life.
So when you heard about the news, where were you?
I was actually getting ready to go on vacation.
Where were you going?
LA. Yeah, it was a short 4-day vacation with my family, with my daughter, and you can imagine that vacation didn't go well for me. Yeah.
Yeah, okay. So maybe walk us through, this is very fascinating, since you're with them, you got the news, what were you going through? What was the rundown?
So on Thursday, I do some tradings personally, right? So I check stocks, and then SVB stock just popped up, and because I follow SVB stock, right? Even though I left the bank, I saw the bank was down 50%, right? Around like 11-ish a.m. And I just said, well, why? What's happening? So I texted one of my coworkers, right? Old coworkers at SVB, said, hey, what's going on over there? What's happening? So you're saying that, the bank just announced they're just sold some of their securities, big hit on portfolio, and trying to respond to get liquidity. So I said nothing gonna happen, so we can have more on Friday. So okay, I said, I'll just call back because I'm getting ready for the trip.
Yeah.
So we drove from my home, I live in Fremont, so down to LA overnight to LA. So in the morning, I checked my phone again. Wow, FDIC took over the bank. So I was like, wow, that was a shocker. And I started texting again, saying what's going on, and they said SVB is no longer exists. So the bank is taken over by the Fed. And it was a total bummer because I know personally a lot of my coworkers they are heavily invested or tied to SVB stock. Their retirement, their personal assets. So a lot of people actually lost millions of dollars, and their entire retirement funds was wiped out. Yeah.
I think devastating would be the least word that we can use in this situation, right? Because people's savings in their lives were attached to it, and naturally their dreams, their entrepreneurship dreams, were also crushed.
Yes.
Who do you think is responsible for the collapse of SVB? There's no right answer, is there one?
If you're asking who, well, you say certainly people. Of course, the management, the top management, definitely bears the bulk of the responsibility for this collapse because they made some stupid mistakes and they didn't manage the portfolio well. They didn't hedge on their big bets on the T-bill and the mortgage-backed securities. So things went sideways pretty fast, and then just went. Yeah, it's really bad.
Ms. Liu, you know, with your corporate and securities background as a corporate attorney, would love to understand what were some of the ramifications when such a huge bank collapses.
So on the March 8th, March 9th.
I love that you know the date.
Yeah. March 8th and March 9th, it was the day that Silicon Bank collapsed, and on that day I received a lot of messages and emails from my clients asking me that do I need to withdraw my money from Silicon Bank. At that time I still don't know what happened, and I told them let me and my assistants do some evaluation and give you comment and give you some advice after that. But they told me that my investor asked me to withdraw the money as soon as possible. So after we and we did the evaluation, and we just give them something like that. You need to move some of the money to another bank account. Those kind of general advice. But yeah.
Which bank did you advise them?
Just whatever another bank account you just move to the other one, BOA or Chase or something. Yeah, and but actually when we receive much more and more messages and emails, we realize what is happening. At first we didn't realize that it is collapse. We just feel like it's probably just people are too it's not a big thing, right? But later we find out you should withdraw the money. So from the bank. Yeah, so for the later messages and emails we received, we just reply them, just withdraw all the money out from your bank account. Yeah, it's just like that, yeah.
So when the panic was ensuing, I know under FDIC only 250K is insured, right?
Yeah.
So maybe tell our audience a little bit about that, because it seemed like that is legally what is insured, but other people were able to get out way more. What were some of the circumstances where there were special circumstances where they could be able to withdraw more than that?
But actually it is 25, right? 25,000. 250K. Yeah, it is 250K. And that is also the reason why it costs a bank run, because all the customers in Silicon Valley Bank, they must have millions of dollars, right? They are all startup companies. If you're just a individual, probably you just have 10K or 100K, something like that in a bank account, you would not be worried about that, right? But for a startup company, most of our clients, they have millions, 5 million, 10 million, or even more than that in Silicon Bank. So they're very afraid. That's also the reason why it costs a bank run so fast, right? So people want to get the money out because they are afraid that they will lose all of the money more than 250K. Yeah, so that is the rule. So the FDIC will just make sure that 250,000 to be safe. But just after the Silicon Valley Bank collapse, the FDIC decided to So for this specific case. So the rule is still 250K.
So aren't we special in Silicon Valley, right? They definitely bend the rules for the entrepreneurs that invested there.
You can say so. Yeah.
And you know, you used a very special word, afraid, because that was entirely the sentiment, specifically when it came to investors, right?
Yeah.
So maybe Spencer, you can talk a little bit about as a venture capitalist, when someone is coming in, this is their dream of owning a business, this is their American dream to kick things off. Now you got a loan, things are within the bank, and boom, it's gone. What were some of the sentiments that you were coming across?
Yeah, it was a nervous 48 hours, and I think everybody knows that within 48 hours everything was resolved. I have to say that on Friday when the bank was taken over by FDIC, I was a contrarian, as investors often are, and I said, look, I'm pretty sure everybody's going to be fine. It's not, when you mentioned bending the rules, the fact is that in the last 73 bank failures over the last, I don't know, is it 10 years or 20 years, depositors have always been protected. So the rules limit it to 250,000. However, there is discretion at the federal level, and the discretion has been exercised many times. And then, of course, Signature Bank in New York was also affected at exactly the same time, which I think in some ways maybe helped SVB depositors because it had been one institution alone Perhaps it's politically more difficult for the government to act with two institutions and the prospect of others, then the politics becomes a little bit different.
Aside from the politics, there was a lot of emotion, right? The investor confidence was completely shaken up. And this has been, Silicon Valley has been the hub of entrepreneurship and fostering entrepreneurship. How has this SVP's collapse changed the entire ecosystem?
So again, I'm the contrarian, so I think less than people believe. It's certainly dominated the news for maybe 3 weeks now. Is it 3 weeks already? Yes, it's 3 weeks minus a day.
Yeah.
And I remember where I was because we had an all-day limited partner event. So our investors who have given us money to work with were with us for the entire day, driving from company to company, meeting with startups. And we're all on our phones, watching the news evolve over the course of Thursday. And it's difficult for us, of course, to act much because we've got this investor day going on. There were a lot of emotion, a lot of drama. We had one company in particular that needed a place to receive money because they run payroll for other companies. And I said, look, we collect on Mondays, we disperse on Wednesdays. We had no cash on Thursday because we'd already sent out all these payroll checks. But you know what? Come next Monday, we need to receive millions of dollars from our clients, and where can we do that? So on Friday, they're standing in the lobby of another bank trying to get an account set up, which normally takes 2 business days. And I said, no, I need an account today because I have millions of dollars arriving into my business on Monday. So there were all these things happening. It was a very fraught and busy few days. You asked what's the long term. I mean, certainly, and I think Steve has some perspective because he foreshadowed that. I will say that we do, in particular, very early stage investing. We're investing in companies often that are pre-product, pre-revenue. At the early stage, folks have a lot ahead of them. They're not involved with products like venture debt. They're not involved with some of the things that Silicon Valley Bank did. As they get older and more mature, it'll be more important for them. So I think there'll be an impact on later stage companies. For early stage, I think actually there's a lot more going on in the venture ecosystem over the last 2 years, and this is more of a symptom than actually a cause. And so there'll be some reckoning of venture broadly, not because of SVP specifically, but in a bigger sense.
And since you mentioned Steve, did you see some signs of it that all of us missed? What were those signs?
Well, I don't know if I saw signs ahead of time that everybody missed, but we knew we were in a zero interest world, and a lot of money was flooding the system. And at a certain point, when interest rates rise dramatically, there are going to be repercussions. So Signature Bank, Silicon Valley Bank are some of the repercussions. If you listen to people like Ray Dalio, he's talking doom and gloom. He thinks this is just the beginning. I'm not that pessimistic. And I think the government actually did a very good job of responding quickly and stemming the tide and reassuring people with Silicon Valley Bank, Signature Bank, First Republic. So I think the government is committed to doing whatever it takes to stabilizing the system, although we may see more failures down the road. Interest rates are higher than ever, and this is, and there are people out there managing banks and other institutions that have made bad decisions, and those will come back. For startups themselves, the day it happened, when everything was going crazy, and Silicon Valley Bank collapsed, I got urgent messages from my startups saying, we can't access our money, we need a bridge loan. We need a bridge loan right now. Wow. So there was a bit of panic, but things calmed down. However, what we're going to see in the future for startups is there just isn't going to be as much money. And that's going to severely impact how startups are run. Startups it was all about spending money and growing as quickly as possible. We are in a different world now, and that happened prior to Silicon Valley Bank. Things started to tighten up, but Silicon Valley Bank is just another step in that direction, a very significant one. And we're going to see startups, not spending whatever it takes to grow, as fast as they can and go public, they're going to be much more conservative, and that's going to change the investing landscape and everything else.
Sorry, go ahead, Mr.
Well, I agree with that. And when I said, look, there's broader things going on beyond SVB itself, it's 100% agree with what Steve said. And having been here in the Valley for almost 30 years now, this is not the first time this has happened, right? This is a thing that many people who are investing have not seen before, but this is at least the third cycle I've seen. And in the in the venture world, you have these periods. I mean, .com in 1999 and 2000. People were spending way too much money. Investors were pouring too much money into companies that weren't worth it. Then there was a crash in 2000 run, right? The 2008 financial crisis was a second cycle. This is a third cycle. I don't think it's nearly as deep. I don't think it will be nearly as deep as the .com crash. However, what I'm expecting is more of, if you take a straight line from sort of 2017, 2018, 2019, then there was this bubble that comes up in 2020 and 21. I think we're going to come back to the 2017, 2018, 2019 line. And more or less, if you just pretend that 2020 and 2021 and maybe part of 2022 didn't happen, that would be the soft landing scenario. I don't think we're headed for .com, but time will tell.
Any particular industries during that time frame that are going to be severely infected?
Well, we've already seen that Fintech was the worst of it, right? And we look at a lot of Fintech deals, and even in 2020, 2021, we looked at some of these opportunities and said, how do you fare in a higher interest rate environment? And so we didn't do those deals. You see a whole sector like buy now, pay later, it's coming under pressure from competition. I mean, Apple introduced their own BNPL product, I think today or yesterday. And at the same time, it's a product which fundamentally depends on low interest rates. So there's sectors in Fintech will be the hardest hit, but they're not alone, right? Anybody that is competing with, that has to raise a lot of money, when you have high interest rates, that's tougher to do.
And Steve, you had mentioned that this could possibly lead to a domino effect, right? This is just the beginning of it. So let's be pessimistic for a while, even though I'm a very optimistic person. If we're thinking about a dominoes effect and the investor confidence is all shaken up in Silicon Valley, where would they put their money? Is the money going to be going in outside venture firms, outside of the U.S.? Thoughts?
So, I was just mentioning that there are people like Ray Dalio who are very pessimistic. There's others out there who really see this as a systemic issue. If it's a systemic issue with our banking system, it's going to affect a much broader segment of the economy. It's going to, you're going to see downturns all across the economy because there are a lot of companies in that zero interest world that borrowed a lot of money. They have a lot of debt. And they're going to have to pay it back, especially if they have variable interest rates. They've got to find a way to do that. So there are problems. I don't know if it's going to materialize the way Ray Dalio said. These things are really hard to predict, and the government is going to step in to try to mitigate that situation. But assuming there is there could be a domino effect, right? We've seen this in the past. It could happen, with Lehman Brothers. It can happen again. Fortunately, it didn't happen because of Silicon Valley Bank. The story isn't over yet. We have to watch really closely. But what's happening right now is investors are moving to more conservative investments. That's what's happening. So across the board, people are shifting their money to bigger banks, the JP Morgans of the world, Bank of America, Citi, the too big to fail banks because they know those will be bailed out. People are spreading their money out across banks, diversifying across treasury notes. So you see a lot more people, their appetite for risk, it has gone down. And as we all know, venture capital, we're in Silicon Valley, it's a risk business, right? This business is high risk, high reward. So it's going to slow things down in Silicon Valley. And, it may be a soft landing. That's what we hope, that it's a soft landing. We kind of just chug through it, and I think that's a likely scenario. But you just don't know because there's so many variables out there. Nobody, even the smartest people in the world, can't predict exactly what's going to happen because there's so many dependencies that you just don't realize. So in this scenario, what smart investors are doing is they're de-risking. And we're just going to, I think we're going to see that trend continue throughout the year. Hopefully, when you hit 2004, 2005, we get into a different scenario and things pick up again. We'll see.
Thanks, Steve. Ms. Liu, when you're advising your clients after this collapse, what are some of the advice that you're giving them regarding some of the way they can structure their contracts or any loopholes that they need to be aware of?
I would suggest them to have at least more than one bank account because on that day there are many startups, they want to move their money to other bank, but they find that they have only one bank account, that is Silicon Valley Bank, and they cannot withdraw the money into their personal account, right? So that is the first thing they need to be aware of. And but for the agreement side, I don't think this is something that can be avoided by agreement. So it is the global economic and also like the general environment. It's not something that can be avoided by agreements. But I do feel like that this impact the. At least for that 1 or 2 weeks, it impact the venture capital startup a lot. And just those days, there are a couple of financing I was working on. Both the startup side and the investor side ask us to hold on all the work. Of course, currently they came back and they ask us to hurry up to closing. So we are really busy recently. But just those couple of days, everyone is very quiet and no new clients. Typically, I'm very busy and every day people call me and email me. But just those days, nobody come to me and all the work that is ongoing are hold on. So that did impact the startup and the venture capital a lot.
And George, would you say, are there any key takeaways from this collapse? Did we learn anything?
Me personally?
For you or the rest of the investors? Did we learn anything from this?
I think should be doing more risk control, right? Risk management. I have a So I have a background in risk management. So I'm risk adverse. So I look when I do things, I always think, what are the risks involved? So so from an investor's standpoint, right, you want to invest in startups that are more mature, have more mature ideas, right? They have more runway, they have better team, right? So everything will be more conservative when it comes to decision. And from a startup founder perspective, they want to be more diversified, right? When it comes to hiring, when it comes to managing their funds, where they put their money at. So from a banker, if I will be in banking, right? So things will be a lot different, right? Because SVB no longer there. So who will be filling the gap, right? There will be a lot of there are a lot of conversations going on right now among my old colleagues. They're thinking, oh, who's going to be filling in the gap, because SVB was just taken over by First Citizen Bank, right? So First Citizen Bank is known to be a very conservative bank, right? They're traditionally they are not a bank that are doing this kind of deals, right? We did at SVB. So are they, allowing this kind of deals to be on their books, or they are sort of changing directions down the road? So we don't know. There are a lot of questions cannot be answered right now because we don't know how things will unfold right down the road. So we just have to be cautious and vigilant and
Steve, what about you? Did we learn anything from this?
Well, you learn diversify. Whatever you're doing, there's no better solution than to not put all your eggs in one basket. So that's what we've seen, and it's true of all investing. It's true of anywhere you have your money.
And then more than ever, it seems like the risk adverse factor that George was talking about, that cannot be taken lightly, right? In this volatile economy market right now. Spencer, thoughts?
Well, one thing, I've learned more about banking than I ever thought I would, right? I mean, there's a lot of details about how the banking system works that I think all of us were not aware of 3 weeks ago that we've become aware of. And so that, in that spirit, there's a question I want to ask. We have a lawyer and a banker here. I was told that of the choices that one has for cash management, if you have more than $250,000 in cash, that a checking account versus a money market account versus a money market fund are treated very differently. And what I was advised by a banker friend of mine, I want to check this with you, is that a money market fund is held in the client's account, held in the client's name. So even if the custodian bank fails, there's someone beyond that, and you can actually recover your money market fund because it's actually owned elsewhere. Whereas a money market account is in your bank's name, and of course the checking account is also in your bank's name. So what I was told is that you don't actually have to try to spread your money into 10 different banks or anything very complicated like that. Just make sure that your excess cash is in a money market fund, not a money market account. So does that sound right, or was I misled? Sorry.
Yeah, no, that's, different buckets.
Sounds right, but I don't have direct
I would say
experience
I'm not a lawyer,
on
but
that.
check with your own banker.
Yeah, you have to check with your banker to know more. Because when I was at SVB, I know a lot of my clients have that kind of account you mentioned.
Yeah,
so it's actually
right.
Yeah, it's actually as a custodial account through a third party.
Right,
so
and usually a much larger entity like BNY Mellon who's sitting above you. And now a money market fund, since it operates as a mutual fund, would have probably a 3-day settle, as opposed to you can't write a check on it right away. But in exchange for 3 days, you're not really banking with your bank, my understanding, but check it yourself.
Yeah.
And I think that's a perfect segue. Oh, Steve, you had something to say?
Yeah, I can just interject there because it's an area I actually looked into. Because this has been, I wanted to know with my own money in various brokerages like Schwab. There's talk of Schwab having a run on Schwab's bank and things like that, and I had my money in their accounts. So I was looking into it, and with money market funds, there's a lag before you can withdraw your money, so it makes it more difficult, especially if you're trading stock and doing other things. But there are ETFs out there. There are ETFs that actually invest in short-term treasuries that you can just buy and sell like stocks. And again, they are not tied to the bank because, like you said, they're an ETF, and they're an alternate solution for getting your money in a place that is relatively safer, although in the real world, nothing's absolutely safe.
Well, one of the scenarios that Spencer had shared with us earlier was regarding the payroll, right? So which setup from the market fund and a couple of the other ones that you folks mentioned will be the best way to access the money?
Well, what you have to think about is how much money do you need in each account. So if you're under the 250K limit, you can keep it in a checking account or any sort of bank account is fine. But then if you're over that limit, you might want to look at other types of vehicles, and it depends how you're set up, that you can access enough of that money on a daily or weekly basis that it won't impede your business. So it's really, I don't want to give advice for everybody, but you really have to look at your brokerage or your bank and figure out what works for you and doing your homework. But the one thing I know is that typically securities, like in a brokerage account, are insured by the government. I think it's up to 500K. And an ETF, something like that, is considered a security. And even if the brokerage goes out of business, historically, the securities have always been handed off to the individuals or the companies that own them. They don't go down with the brokerage, although historical precedent could change, right? So we don't know in the future, but that's the way it's been, and that's something to consider when making these decisions.
Well, and there is another factor there, which is when you own securities, you have to specify that they not be hypothecated. Because when they're hypothecated, they move to the bank's name for them to lend them out to short sellers. So if they're not hypothecated, then my understanding is they remain in your name. So.
And I think that's a perfect segue for questions from the audience. Anyone with any questions for our guest speakers? Yeah, go ahead. Oh, Piyush.
I'll just take a hypothetical situation. Given that we've all...
Can you folks here, do we need to give a microphone? Okay, thank you.
Hi, my name is Piyush Malik, and I'm a community member here. So I'm not a banker, I'm not a VC, but I'm an angel investor. So I'll just put it that way. Given what we have seen in the last 3 years, COVID, SVB bank run, and whatever we know as a fallout of what has happened, if you were all given a time machine and you could go back in time to 2019, what would you do differently?
To avoid the collapse of Silicon Valley Bank.
And to be better prepared for future. So this is a hypothetical situation that you have a time machine that we have, because the situation of the bank run caused a lot of FUD in the market. A lot of folks are still very much traumatized by that, and some of the shareholders and the employees, of course, lose their money. But thankfully, FDIC is there. It has controlled the bank run at Silicon Valley Bank and Sterling and First Republic, but there are 119 other banks waiting the wings to fail. The economists have a lesson from here. The government has a lesson from here. But at the same time, we as common citizens, what could we do differently now that we have seen the vision of the future with this failure? Hope this makes it interesting.
Steve, you want to take a crack at it?
So what can we do different? That's a good question. This is, for most of us, we didn't see it coming. We didn't see Silicon Valley Bank going under, especially so quickly. I remember back in the dot-com bust, there was another bank that was lending to startups for venture debt financing that collapsed. There were actually more than one that went down. So there's a historical precedent for this. But I assumed, like so many others, that Silicon Valley Bank, with its 40-year history, it survived the dot-com bubble bursting. I assumed that their practices were better, but we didn't know. So a lot of it is we're busy. Like for most of us, like I'm focused on startups and helping startups get what they need when they need it. That's my job. I'm not a banking expert, so I don't have time to research, due diligence on all these banks and everything else. And most of us, we really don't have time to do that in our lives. So you ask a great question, and all I can say is that whenever you're doing business, whenever you're investing, you really, it's good to talk to people inside the industry and start to get their perspective. Because one thing we saw was that the insiders on Silicon Valley Bank, they were actually selling their stock. So they sold a lot of stock, and that problem with the treasury notes was known that they would have to sell off the treasury notes, I think as early as November, and definitely by December. The executives inside, this is what I heard, Silicon Valley Bank, they knew there was a problem. So there are people who know if you can get through to them.
The gentleman behind actually had a question.
Hi, I'm Christian Moran. I'm an investor at Pegasus Tech Ventures. Hey, Steve, how you doing? Just had a question. Silicon Valley Bank had negative equity for a while, and the market hardly reacted. Regulators apparently didn't react at all. I feel like it's unfair to put the onus on startups to do that level of due diligence. They definitely have more important things to, tend to, especially when market and regulators aren't doing anything. So why wasn't more done?
I'm not sure if I can answer why wasn't more done, but I will say I wrote a piece on LinkedIn today about 5 reasons why Silicon Valley Bank failed, and the point of it was to avoid simplistic or one-dimensional reasons, because when people are putting forward one reason only, and then what they're really doing is trying to distract you away from the other reasons, because really there were, in my mind, there were 5 important failures, and all of them need to be fixed. Regulation was one of them, definitely. And the previous question, what if you could go back to 2019? You kind of have to go back to 2018, when the oversight of banks below 250 billion was loosened, and that was clearly a mistake. It shouldn't have been done. Now, if it were me going back to 2018, could I convince Congress to behave differently than what they did? Not very likely. A lot of people were trying to do that in 2018 and were not successful. But what Congress should have done in 2018, obviously, is retained oversight of banks in the 50 billion to 250 billion range. It's not actually clear to me that their equity was negative. We can debate that later, but certainly it's also the case that there is no bank in the world, and there never has been, that can withstand a run, right? You try to take out 46 billion of cash in one day. So I think there was also some irresponsibility on the part of certain venture capitalists who sparked a run where, by the way, if folks had left their cash alone, the bank would have played out fine, right? Because a $2 billion loss on a bond portfolio on 200 billion of assets, that's 1%, right? Not that big a deal.
I just want to add a little bit color. So I personally think the collapse of SVB is a perfect storm being brewing for a while. It has the external factors of Fed, dramatically increasing rates over the last 18 months or so. And also we have this downturn in technology industry, right? So the VC funding rounds are sort of slowing down. The money going to the pool is getting smaller, right? The VC funds is getting smaller, and also the technology startups is receiving less funds, and they're drawing on their prior funding rounds, right? So that's why it caused SVB contraction of their entire deposits. That's why it triggered the sale of the treasury notes, right? That resulted in a loss of $2 billion, like $1.8 billion loss, right? Also, and there was mismanagement, bad management at the very top of SVB's board, and also their executive team, right? So it's sort of a perfect storm that brewing for a while, and then it's poorly executed by the top management, because I know the communication piece, I read it was terribly drafted. I don't know who wrote it, but it's because no other people other than a banker will understand what's going on in that piece, because it's so I don't know, so technically or so technical or somehow I have a banking background, underwriting background, so I know what's going on, but for regular folks, they don't know what's going on, so they think, oh wow, this gotta be bad. So that triggered a panic really fast, and then thanks to the social media, also technological communication we have nowadays, that triggered a domino effect, and then that's really bad. So so I think down the road it's going to be very different, and then the road will be very bumpy. So yeah.
Ms. Lu has something.
And another thing I would like to talk about is that what caused the bank run so fast? One of the reasons is also due to lack of diversification. And not just the diversification on the investment, because Silicon Valley Bank invests a lot on the mortgage-backed securities, as many people may know, right? Another thing is that they also lack of a diversify on their customer, because all of their customers are just startups, right? Just like the other bank, Signature Bank that Spencer mentioned just now. Signature Bank is also very specific on just a couple of one type of customer. I heard that many law firms open bank account there. So if you are very special, focusing on just one kind of customer, then the news will spread very fast in their circle, right? If it's just like other bank like BOA or Chase, they have many customers and the customer don't know each other, right? But the startup circle is very small, right? So just in a couple of hours, the news spread to all the circles. So it would cause the people go to withdraw the money very fast. That's also one of the reasons, right?
Yeah. Anyone else that had any questions? Go ahead, sir. Can we pass the mic to him?
So this whole Silicon Valley Bank collapse, so the way I understand it, it could have been avoided if, one of the things that was passed during the Trump administration was not done, right? Like, some of the banking regulations were relaxed. So isn't the obvious solution just to go back and reverse those?
I would take away the just, right? You say just do that. That's the simplistic solution that I was warning against. I think there's many factors, and I do think that needs to be reversed. In this particular case, I don't think that Trump and the Republicans have been any friends to banking by virtue of the actions that they've done. I think they've made the system much more unstable, but that particular legislation was bipartisan, as it turned out. So there were mistakes on both sides. It should be reversed, and it's not the only thing, right? In addition to that, the supervision under the regulation wasn't exercised the way it should have been. So you have a regulation that was relaxed. You have then a regulatory framework that exists where the execution of it was not proper, and you have a rapid interest rate rise, and you have a concentrated customer base, and you have irresponsible venture capitalists. So it's all of the above, and they all need to be fixed.
Anyone else? Was anyone personally affected by the collapse? Or family member? You did. Oh. What would you say? You were personally? Oh, you had a question? Yes, absolutely. Yes.
Hi, I'm Chen. So because I think everyone talks a lot about the effect on the small technical startups. I just wondering, is there any side effect for the big IT company also? Because the reason is, let's say the startup has limited funding, they are more difficult to get more money compared to like 1 or 2 years ago. Maybe they have very limited budget for ads to spend more on ads compared to 1 or 2 years ago, and also have a limited budget to buy technical service like cloud service, where it also affect the like big IT companies.
Was it just smaller startup companies that were affected, or bigger IT companies? Did I get that right?
Yeah.
Okay.
Yeah, I would answer that.
I heard that Meta also has a lot of money in Silicon Valley Bank.
Oh, yeah.
But yeah, I don't know much about details, but I'm sure that also big companies are impacted a lot.
So just a little more color. So I think the money is safe, right? I think what if I were a entrepreneur, I'll be worried about my loan. So what's going on with because a lot of my old clients, they have a bridge loan, what Silicon Valley called an extended runway loan, right? So you have money, right, from the VC, and then you have maybe another, let's say, $2 million, $500,000 or $3 million of a loan from SVB to extend that runway. So if I were an entrepreneur, I'll be thinking about, that runway, that extended runway could be gone, right? I'm only going to be relying on the money from VC, right? So that is still a question mark, because SVB was taken by a different bank, and then the other bank's risk appetite, what's called the risk appetite, will be different. So things will change, definitely change, yeah.
When First Bank took over, did they also took over the extended loan that you were talking about? Or are they going to, so this gives the investors a little bit of they can sleep better at night?
I believe at the meantime, the loans still exist. They're just because I was responsible for renewal. So because the loan typically renewal only lasts for a year or two, and will renew annually based on what your financial say well-being or your right. So I was a person that conducted those exams or analysis. So and that the credit risk policy, underwriting policy changed dramatically after the takeover. So that is remaining unknown right now. So, right. So if I say I have a loan with SVB before, but with a new bank, I probably won't get it based on the same risk profile. So, right.
I hope that clears up that question. Any other questions, folks? Yeah, go ahead. The lady behind you. Thank you.
Oh, hi, I'm Deborah. So just wondering, how do you foresee the ecosystem that you've been talking about will restore after this incident? Because it sounds really serious, but like at the same time, not many startups actually die, or it's just like, what being said, it's like people are being more conservative, and like maybe consider like diversification more. And so, yeah, how do you how is it only a matter of the interest rate, and the Congress and their decisions? Is there other way you foresee it to happen, and when possibly it could happen? Yeah.
Well, I can talk to that a little. So a couple things from the previous question too. How does it affect larger tech companies? Well, we've already seen a big drop in ad revenue. And this is partially due to startups having less money to spend. Like startups were big funders of online ads for their growth. So, companies like Google and Meta and anybody who's ad dependent, even Amazon, they're feeling the pinch in terms of that. In terms of the whole ecosystem, we're already seeing that the pipeline, the IPOs just aren't happening like they were. So, things are getting backed up in the pipeline. And a lot of startups, they have a certain amount of money to get to a certain point. And if the goalposts keep getting moved further and further back, the ultimate goal of all the venture capitalists is to get this company public so they can get their money out, pay their LPs, raise another fund, invest again. That's kind of on hold now. So what we're going to see is that there's going to be a greater number of these startups that simply don't make it. They will fold. And other startups will just have to scale back and survive this time until the money starts flowing and then ramp back up. And that's kind of what's going on now. It's mostly affecting not the earlier stage companies because they're so far away from that. But the later you get, the closer you get to having gone public, but you haven't gone yet, the more impact it has. So that's what we're seeing.
Great.
I'll quote you asked how the system itself recovers. So there's a difference between how individual companies will recover and how the system overall recovers. And to Steve's point, many of the individual companies will have difficult times, and some will fail, and some will take down rounds. The system as a whole, I'll quote Warren Buffett from 1983. He said, what were the exact words? He said, you need to be fearful when people are greedy, and greedy when people are fearful, right? This is a time when there's a lot of fear out there. And so therefore, what happens is those who are greedy in this time, those who are contrarians, will come in to fill the void, slowly at first, and then more, and that's how a capitalist system corrects itself, right? That's the invisible hand, is when everybody else is pulling back, some people lean forward, they're going to make good returns, they'll attract others in, and that's how the system as a whole will recover itself.
And since the quote is from 1983, that's when Silicon Valley Bank started. So the irony in this, right? Well, ladies and gentlemen, I know we're just at the near end of our event, but any final questions or thoughts? Can you take the microphone to the girl in the black jacket? There's lots of black jacket, but you know what I mean.
Yes. I was wondering if you see the Fed taking any action to deal with the recent events with the bank collapses.
We don't know yet. So short answer. So there will definitely be a lot of hearings, and it's actually already started. So they're going to look into this fiasco of Silicon Valley Bank, what's going on, and then there will probably be new legislations introduced after this, yeah, to prevent similar things to happen, yeah. That's what how democracy works, I believe, yeah.
Okay, I think with that, we are concluding our event for today. Really do appreciate all of our speakers for spending the evening with us and sharing your knowledge and expertise. Thank you to all of you for being here and participating and joining us at the Silicon Valley Entrepreneurs Forum.